received a call from a real estate agent asking me if I could help her 83-year-old widowed aunt who was facing foreclosure. She had a tax sale date 2 months away for $84,000. Aunt Diane's house was worth $2 million, but her fixed income was too low to qualify for a traditional loan, and her family didn't have the financial resources to help. Aunt Diane was competent, but had health issues due to complications from hip surgery. Her paperwork wasn't very organized, and when in financial trouble, she was too proud to tell her family that she was behind on her taxes and living without insurance or gas for heat. We got a contractor to do minor home repairs and wait until closing for payment. So Aunt Diane was qualified and approved with a week to spare. The lender held an escrow so that property taxes and insurance were funded for the next 20 years, and there was money at closing to modernize her heating and air conditioning. In addition, funds were available to increase her monthly income and guarantee that she would age with dignity in her home. Their retirement planner referred me to a senior couple over the age of 65. They were looking for a creative way to pay off personal loan debt that they had acquired while fixing up their home to make it more age-in-place friendly and for a new car. In addition, they really wanted to help their only grandchild and pay the tuition for his last 2 years of college. The challenge was they were on a reduced fixed income with only Social Security and a small pension, and couldn't qualify for a refinance of their mortgage at an acceptable interest rate. Plus, even if they could, the new payments would have really cut into their standard of living. We successfully got them approved for enough funds to clear all the debt and get them enough cash out to fund 2 years of college expense for their grandson. Plus, we set them up with an emergency fund to avoid their having to go into credit cards if unplanned expenses arose. Now, their retirement really is secure. From a retirement planning point of view, a reverse mortgage is an opportunity to incorporate a dormant asset class, or home equity, into the financial planning process. And it specifically works for mass affluent clients with a net worth of anywhere between $500,000 to $9 or $10 million. For a lot of them, home equity does represent a large portion of their net worth. And so, when you're looking to plan a 30-year retirement for your clients, it doesn't make a lot of sense to me to leave this portion of their net worth, home equity, out of that planning process. So, using the reverse mortgage gives you access to capital again with no required principal or interest payments. And you can bring that capital into that planning process for whatever you need to do, whatever you need for it to do. So this is ideally suited for the majority of baby boomers aged 60 or older. You must be at least 60 to qualify for one of these loans, and it is beneficial to discuss home equity as they are rolling into their 60s. So let's have this conversation. Once you hit your 60s, it's kind of like the light goes on, and you're stuck with the fact that you're in your last decade of working, and you really need to start planning how you're going to fund the next 30 years or so of your life. Because you're pretty sure that your mind and your body isn't going to be working perfectly till 90. And this is a great time to have that conversation about home equity. Doesn't it make sense to bring it into the planning process in one's late 50s or early 60s? Most mass affluent baby boomers have the lion's share of their wealth tied up in their homes. The sooner home equity is brought into the conversation, the greater the chance of not running out of money in retirement.